Hey,
Hey everyone, Ryan Bolton here, Ryan Bolton, local mortgage expert. Check out my website at ryanbolton.com. But today we are answering more questions about real estate and mortgage financing. So the first question I have here is, what is the difference between private mortgage insurance and government sponsored mortgage insurance? It really just comes down to the guidelines that issues that insurance. So when it's government backed, they just simply have programs that if you follow those guidelines, they will then offer the insurance. They work very similar. There's some different ways that who owns the property afterwards or who goes into foreclosure. I mean, so there's definitely a little nuances with it, but really as far as the consumer is concerned, it's just the different type of loan. So if you typically the private mortgage insurance as we know it is usually a little higher end, higher credit score type of borrower, where a lot of the government backed ones will typically go lower credit scores, less money down. So they just open up things that private mortgage lenders or lenders that are offering conventional loans, maybe somebody can't qualify for. So every mortgage out there is trying to fit a need within the marketplace, just like every mortgage insurance option is trying to fit a need to help people into homes. The government backed ones are usually a little bit looser in some areas and stricter in other areas, but usually designed a little more for first time home buyers, maybe people that have a lower credit score, maybe not quite the job history. Things like that is what the government ones are a little bit more common for. But that's part of my job, is to sit there and say, okay, here's the programs you qualify for. Here's the pluses and minuses of each one. But that's how it works. So there really isn't a difference as far as consumer. The payment amounts are different. When you can get rid of it can be different. There's not like a plus or minus where the government ones are better than the private ones. It really just comes down to each individual borrower, which product is trying to fit the need. That's really the difference between the two. Next one, do FHA appraisals come in lower than conventional? They shouldn't. There shouldn't be any difference on if it's an FHA to conventional as far as the value of the home. Now, an FHA appraiser may have to go up into the attic or turn on the faucets or check for railing issues or roof issues. So they may do a little bit more comprehensive review of the property, but they're still not supposed to be any different when it comes to value, just maybe pages and photos and certain things that FHA wants to see on the report where conventional doesn't. So generally conventionals might be a little bit easier on the appraiser as far as the stuff they have to do, but it shouldn't affect value. So I'd say no, an FHA appraisal shouldn't come in different than a conventional. All right, let's go to the next one. Oh, this is a good one. This is actually a pretty interesting one. I've run across this one a couple different times. Let me open up the whole thing here, make sure I read it correctly. So if you pay more than your monthly payment on your mortgage, why doesn't it count towards advancing the payments? The amount reduces the principal, or the capital is what it says here. I think they mean principal. So the amount reduces the principal, but the installment is still due. Overpayment doesn't count towards future payments. So sometimes, like with car loans, if you have say a $300 payment, or say 390, and you just round it up to 400, eventually that extra $10 or $50, whatever extra, kind of starts to accumulate, and all of a sudden you don't have a payment due because you've been prepaying that amount. So you don't owe a payment. With mortgages, the interest is calculated a little bit differently, and the note basically says that whatever payments you make go to certain things first. Whatever's above and beyond that, unless you specify, goes right to principal. And so the next month you still owe the minimum payment, just your balance is advancing. So why this is beneficial as well is once you pay the interest due that month, you can put the rest of it all to principal. The interest is less the next month, instead of being a fixed rate amount of interest regardless of how long you have the loan, unless you just do a lump sum and pay the entire thing off. So mortgages do allow you to put more towards principal, and then the interest is owed less, which reduces the term. And so really it's just the way mortgage loans work. Sometimes that's just kind of how it's done. That's how the note reads. That's how payments are credited when they come in. It's written right into the note. Now, I do know lenders that will say, okay, if you call them up and say, I want this additional amount to go towards interest or my next payment or things like that, they will do it. I don't know of anybody that goes past like 6 months. I know some companies let you do like 6 months prepaid payments, but generally speaking, it goes right to principal. So I remember I had a client that did that just paid up $10,000 and thinking they didn't have a payment due, and the next month they had a payment due and they didn't know what to do. So it is something, whenever you pay extra, unless you want it to go to principal, you do want to direct where that extra payment goes. So even statements in the past, now everything's gone digital and nobody gets statements in the mail anymore, but they used to have a box where you can check, I want this additional money to go to escrow or to principal or interest or wherever you want it to go. Then that could direct that a little bit more. So it's simply just the way mortgage loans work, and it's the way that the payment actually gets credited. It typically goes to interest, escrow, principal, and mortgage insurance, and then whatever's left over goes directly to principal. All right, let's go back to some more questions. Yeah. All right, let's check this little box here. How can you find out if your bank will give you a mortgage before applying for one? You don't. I mean, you really don't. How can you find out if a bank will give you a mortgage before applying for one? Now, you can obviously talk with the loan officer, get a basic idea, but you won't know for sure until you actually apply for the loan. So, I mean, when the clients come in here, they don't want to pull credit yet. They're not sure where they're at in the process. They just want to get a rough idea. We can easily do that. We can go through their debt ratio, maybe kind of see if they know what their credit score is. Maybe they have a Credit Karma or some sort of credit tracking, so we can kind of get an idea where their credit score is. But none of it's going to be for sure, and you won't get that pre-approval letter until you actually apply. So don't be afraid of applying. That's really, there's this weird thing, I don't want to apply yet. Apply earlier usually helps you way more than applying later or waiting until the last second and all of a sudden be rushed to try to find the loan. Plus, if you're really serious about buying a home, be serious about applying for the mortgage, because I can't tell you how many times people will be at the end of their lease or need to move out by a certain period of time, and so they put themselves in this weird time crunch. They put arbitrary deadlines on things and just put so much more stress on it than if we would have just had a week extra or 30 days extra to be able to work on maybe tightening up the credit a little bit. Maybe there's a couple little things we can do to boost the score a little bit, or have some savings, or make your offer stand out more because you can close faster because we got all our ducks in a row. So it's a weird thing I see out there. People just don't want to apply. Maybe they don't want to commit yet. Maybe they don't want a fee or waste somebody's time. I mean, don't worry about that stuff. Really don't worry about it. That's what we're here to do. We're here to help you. And by you being available to do the applying for the loan sooner, you'll get a better loan. You'll get better time frame. You'll have less stress. So if a bank issues a mortgage or a pre-approval without going through applying, it's garbage. It's complete garbage. Because what, they pull your credit and all of a sudden there's some late you didn't know about and your score's down. Now you got earnest money at risk, or now you've got deadlines, or you've given notices, or you've done stuff because you thought you had an approval that you really didn't have. So your pre-approval is only as strong as you applying. And if you're not even applying, your pre-approval is garbage. It flat out is. Now I have people, I'm 800 score and I may call you. Sure, they might, but still apply. All right. That's a soapbox for you. Let's see. What is needed to prove one's income when applying for a mortgage or renting an apartment? Those could be totally different things. Renting an apartment could probably be maybe easier in a sense. I mean, right now it seems to be harder in some areas to even rent an apartment. It's almost like the same as going through a mortgage process because of just high demand or low access to rental properties. But from a mortgage standpoint, they will want to verify your income. Now, income is earned a million different ways, whether it's self-employed or W-2, whether it's 1099 or W-2, or whether it's tips, or whether it's salary or overtime or bonus or commission or Schedule C's. I mean, there is all kinds of different income. And guess what? We as lenders have come up with a guideline for just about every one of them. And if we don't, we usually have a guideline that basically says, okay, this is most similar to this, so follow this guideline. I mean, there's guidelines for everything, especially income, because it's such a huge factor on determining your ability to pay back the loan. So what's needed to prove income is to show it's consistent, to show what the job is, what type of income it is. Most commonly, it's going to be a pay stub, W-2s, tax returns. That's going to be most common. Now, there's loan programs out there that don't require those things, but they're going to require higher credit scores or higher interest rates to offset the risk of income. So a lot of times I help people review their tax return, especially if they're self-employed, and say, based on this year's tax return, this is what you qualify for. And then they can tweak the next year's or amend, or a lot of times people don't file the same as if they're W-2. So maybe they file an extension and we can kind of tweak the return before it gets filed. So part of my job is to review that income and find out where we're at. So what is needed to prove one's income when applying for a mortgage loan? Talk with a loan officer, talk with a lender. They will give you a checklist of what documentation is most likely needed based on how you earn your income. All right, we're about 10 minutes in, so let's see what else we can do. Let's see. How can people afford a $1 million mortgage? Have the income to qualify, have the credit score to qualify. So whether it's $1 million or $100,000, guidelines are very similar, like incredibly similar. Now you might have different seasoning. I mean, there might be some little differences, of course, but there's nothing that really constitutes a real difference between those two amounts. They have guidelines. If you follow the guidelines, you get the loan. Now, how can people afford that? They have more income to afford it. They have more assets, maybe, or maybe less debt, so they can afford it. So it really isn't different from a lending company. Really, guidelines change, obviously, a little bit based on that type of borrower, but it's how can people do it? They have the income to qualify. Let's see. What are the consequences of not paying back a home equity loan or line of credit? So, home equity line of credit, HELOC is what it's called. Home equity line of credit is typically a second mortgage. It's leaned against the property. You don't make your payment, they take back the collateral. Whether it's a car loan, a mortgage, a home equity line of credit, it's tied to collateral. It's tied to something that if the lender doesn't get paid, they can take something back to recoup their investment. So just because it's a line of credit that's similar to a Visa doesn't mean they don't take away your home. So if you don't make your payment on your line of credit, you lose the house eventually. Oh, right underneath, what happens if you can't repay a mortgage? That is the collateral. So if you put the home up as the collateral for the mortgage, that's why they're loaning you the money, is because they're tying it to the piece of property that they can take back. So like a car loan, you could just drive off with that car, you could throw it into a ditch, you can do all kinds of different stuff. Where a home loan, obviously you could burn it to the ground. There's things you can do to that home as well, but it's a little bit lower risk knowing they can't move it. It's stuck, it's locked in place. It's a place that they live, their kids are there. It's one of the lower risk loan you can do out there, is typically on a home loan, but it's still the collateral. The collateral for the loan is the property. So if you don't make the payment, you don't stay in the property. They eventually can take it back. Now, there's waiting periods, there's protections, state and federal laws on what a lender can do to actually foreclose on the property. But long story short, no pay, no stay. All right, what else we got? I have fun doing this. I do. I just have fun with it because I think it's fun to just off the cuff answer these questions and help people where I can and show my expertise. And I really like what I do for a living. I really do. So this is just fun to be able to answer questions for people. So if you do have a question or comment, concern, topic, please post it. Check out my other videos, subscribe, like, share, all that stuff. All right, let's see. What happens to the down payment on a house if you don't get approved for the loan? Well, the down payment's at the time of closing. So it's not like you have to put the down payment with the mortgage company or with the bank. And then if you don't get the house, they just keep your down payment. So the down payment only happens when you get the house. So you go to closing, the lender sends their money, you send your money to a title company. Typically, there are some attorney states out there, but throughout most of the country, here in Utah and Nevada, the money all goes to the title company. They all record everything, clear off all the liens, clear off the previous owner. Then you get the house, you get the keys, you get the garage door openers, whatever it is, you get all that stuff. So the down payment doesn't kick in until you actually get the house. So your approval for the loan won't take your down payment if it doesn't go through. Now, earnest money is a little different. So earnest money is tied to the contract. So when you put an offer on the home, they want to know that it's serious. They want to know it's legitimate and legitimize the contract by putting a deposit on it that shows everybody you're serious and shows the seller that if you don't execute your end of the deal, they get to keep the earnest money deposit. That's different than the down payment required for the home loan. But you wouldn't just lose your down payment, and you won't lose your earnest money unless you pass deadlines that you don't execute on the contract. So typically there'll be a seller's disclosure, home inspection, financing and appraisal, these deadlines that if you pass that deadline and then try to use that as an excuse to back out, it's too late. They get to keep your earnest money. And when you think about it from a seller standpoint, if it's been 30 days, they've had their house off the market, nobody else could put an offer in, you've kind of tied up that property, and then you just get to go away with no repercussion. The earnest money is a way to basically be able to say, hey, look, I thought I could do the loan. I thought I could purchase it. Something happened. All kinds of things happen. That earnest money stays with the seller to say, okay, sorry, we weren't able to get this deal done. You get to keep the earnest money. But that's usually way late in the ballgame. I mean, there's way more protections for buyers than sellers, but that is one thing when it comes to the distinction between down payment and earnest money. Now, the earnest money is a credit, so it can go towards your down payment at the end. So it doesn't just disappear either if you're buying the home. So it is something where that just becomes kind of a credit. You've got your mortgage loan, your down payment, your earnest money are all credits. Then you have the purchase price and the closing costs are all minuses. So it's plus minus to zero everything out. So that's kind of how that works. So, all right, let's go. What else we got here? Got my fancy new microphone. I hope it's sounding better. So I've been working on that too. I'm probably going to work on getting a little better camera as well, but I just enjoy doing this. So let's keep going. What was, oh, never mind. So the question is, what was spanking called at your house? Why that's in this category? I guess because it's a house category. Spanking called at your house. Well, cutting your own switch. That was one. Or there's a different kind of spanking I'm thinking of. All right, we're going to move on. What would happen if someone stopped paying their mortgage with only $2,000 left to pay and the home is worth $100,000? Would the bank take the home, sell it, and give you the difference? Yes. Yes. So if anything is above and beyond what the balance is on the loan and the home sells for more, the seller would still get the proceeds of that in most states. That's most states. Now, it could be the balance plus attorney fees. There's other things that kind of kick in that's maybe more than what's owed, maybe back interest and escrow accounts. I mean, it's usually not just the balance. I can't imagine somebody letting it clear down to $2,000 and just walking away at that particular point. But yes, if they sell it for more than what is owed after everything's said and done, then the seller would get the difference. Or the homeowner, the homeowner, the seller. So the homeowner that owns the house, if it goes into foreclosure, if there's anything left over, it goes back to the homeowner. Let's see. Why is it so hard to sell a house in 2022? Depends on the market. I think there's still some crazy good markets out there. There might be some that have softened and slowed down a little bit because it was just way too hot. So whenever anything gets too flung to one side, whether it's politics, whether it's anything, there's always this balance. It's always trying to correct. It's always trying to go back to whatever it is. So there might be some areas where it's harder to sell a house, but if it's set at the right price, it has the right amenities, it'll sell. It'll sell in every single market. There's always going to be buyers and sellers. There's always going to be things, but this person obviously must be having a hard time trying to sell. It might just be the area it's in. There's some areas that are affected way more by, say, drilling for oil. Might have an area where, like in Utah, there's a couple places that just go nuts when they're drilling for oil. When they don't, it goes down. It's a roller coaster what happens. I know that's happened in some areas like Silicon Valley and stuff where certain industries are so heavy in an area that once that industry has a slowdown, it kind of affects the whole area. That's why the securitization of mortgages has really helped the housing industry because it diversifies that risk. So you don't have all your eggs in one basket like a regional bank or local bank that's very heavy in, say, like Detroit or something that's really heavy in the auto industry. And all of a sudden the auto industry goes through major changes. There's no other industries to kind of balance it out, and just people end up leaving in droves. So it is something where, why is it harder to sell? It might just be the price, location, area that you're in might be going through more of a downturn than other areas. But I can tell you right now, there's some areas that are still crazy and probably still will remain crazy as the market shifts on where people want to live and work. And remote working has changed things a lot, where people can almost live anywhere they want now and work remotely. That's really changed the landscape. So people are moving out of areas that are just less desirable, and maybe there's just a lot more competition. Let's see. Can housing ever be affordable again? This is a big question. We've seen it here in St. George like crazy, how the home doesn't feel affordable to the locals. But you have people that are coming from outside the area and they see the value and they're going, man, this place is amazing. I just sold my shack for $1 million and I can buy a mansion here for $600,000. So affordability is all perspective. Yes, there's affordable homes. I know there's homes right now that you can move into Detroit if you want to move there that are $40,000 for the whole house. But you're going to have a house that's in San Diego on the beach or in Los Angeles down, whatever, that's going to be 1,000 square feet. That's going to be $2 million. So affordability is always going to be perspective. There is going to be areas that are going to be affordable. It's just, do you want to live in that area? Do you want to live in, just in the middle of Idaho or Montana or some of these other areas that may not be as desirable as where you want to live, work, and play and all those types of things. So affordability is perspective. It really is perspective. I know people that move here that just think this is one of the most affordable places you could ever live, and other people that are just literally getting pushed out of the market because it's not affordable. All right. If a homeowner can't afford property taxes, what can happen to the owner even if the house is paid off? Again, it's not really collateral for a loan, but property taxes can supersede mortgages. It can be where the state or county can literally foreclose on the back taxes that are owed and take back the property to pay those taxes. That's a horrible situation, really, especially if it's free and clear. Usually, this would be a situation where it's an elderly person. It's horrible, and it usually takes a long time for the county to go into that state where they actually foreclose on the home. Usually, it's after a death of somebody. I've seen that happen a lot more, where the county gets a more aggressive if it's actually somebody's passed away, or the home is just becoming a vacant, abandoned home type thing. You see that a lot more often. But the short answer is, if the taxes aren't paid, the state, federal, the government, whether it's the county, the state, can take that property away and go through a process to notify everybody what's going on. But typically, the home can be sold before it goes that far if it's a death of a family member or something like that. But even if it has a mortgage on it, if the taxes aren't paid, they can literally take back that home to pay the taxes, and the mortgage company's out their money. That's why a lot of mortgage companies really want to have escrow accounts to make sure that stuff gets maintained, even if it's a reverse mortgage or something like that. So, short answer, they can take the home away. Let's see. Is it true if you finance a home, you end up paying double the price? Well, um, that's the idea of how much interest you pay over the life of the loan. Sure. That's over a 30-year period. So, yeah, if you pay that payment for the whole life of the loan, principal and interest, yeah, you might pay double for it, but you also gain all the appreciation during that entire time. You already are going to have a housing expense most likely. So, why not own it instead of just renting it? And most people will not keep the home the entire life of the loan. So, sure, it can be. I mean, the answer can be sure, it can be that you're basically paying double over the 30 years, but you're stretching out what you owe over that time frame, making it much more affordable to pay for the house. And you're able to use that money other places. So, I'm a big believer in real estate. I'm a big believer in mortgages, that you can leverage your money better. You can buy multiple properties with less money down. You're going to have a mortgage. You might as well be yours and not your landlord's. I use that saying all the time. You have a mortgage if you're renting. It's just somebody else's. So why not get the benefits of the tax benefits? Why not get the benefits of the appreciation? Why not get the benefits of locking in the payment? A mortgage payment's going to be way more consistent than a rental payment. Anybody's been paying rent over the last couple of years, has it gone up on every renewal? I think everybody's seen their rent go up a lot over the last couple of years, unless you got some little old lady that doesn't care and always collects the same amount. I mean, there's definitely people out there that haven't raised rents, but generally speaking, rents have been going up a lot faster than any mortgage payments have gone up over the last 5 years. So locking in the payment, having it more consistent is better than the idea that, yeah, you're going to pay all this money in interest. Yeah, over the entire life of the loan, sure, but it's still cheaper than other forms of housing for sure. So anyway, I'm a big believer. I'm drinking my own Kool-Aid at this point, but I believe in it. I have a bunch of rental properties. I own a bunch of properties I have and sold and bought and sold. It's great. It's a great industry. There's a lot of wealth that's been created with real estate as well, if it's done right. And I tell you, a lot of people that have these $1 million homes and $1 million, they don't have them free and clear. Why would they tie up the money? They can use it for other businesses. They can use it for other real estate. They can depreciate things. There's just no reason to have it free and clear. Oh, let's see. Oh, I did that one already. Let's see. Do you agree with my realtor that I should host a fried chicken buffet at my house showing to attract potential buyers? She is saying she will 1% into her fee to host it. Wow. Okay. Do you agree with the realtor that I should host a fried chicken buffet? I'm in. How good's the fried chicken? It's about attracting buyers, and maybe you're going to have more people show up. I would say that you're going to get a lot of people showing up just for the chicken and not for the house. So maybe that's a little too gimmicky when you can do other things to draw attention to your open house. But I mean, that's also a fun way to get maybe your neighbors involved. Maybe they got a family member that wants to move into the neighborhood. So I would say that would be almost a fun thing to do as like a neighborhood thing, more so than just out to everybody, because you're going to get a ton of people just eating fried chicken. But maybe you do it as kind of a neighborhood party kind of thing as part of your open house, to just have neighbors come by, because neighbors always want to see inside your house and see how it's different than their house and how it's decorated and stuff like that. So I don't think it's a terrible idea, but be prepared to get a lot of free chicken out. And I guess I'm in. So when you have this buffet, let me know. I'm in. I'll come over and have some chicken. Let's see. Oop, clicked the wrong button, went into the wrong screen. All right. So I'm going to find some more questions here. I hope you're having fun with videos. I really do have a lot of fun putting them on. If you have any questions or comments, topics, please let me know. And let's see. So I have a little tab where it's questions for me. And let's see. Where's the mortgages one? Let's do mortgages. Yeah. Real estate financing questions. Okay. What is subprime mortgage? So subprime used to be a term where if it didn't qualify for conventional or other type of loans out there and didn't have certain general ideas of what's a prime loan, these were loans that just fell just under that. There's also alt A is what used to be called alternative A that would just not quite fit in the box because of income or credit score or debt ratio or something, but still made sense to do. It just usually had higher interest rates to offset the risk. So a very common one was like stated income loans. So you have somebody that was self-employed that made a bunch of money, but wrote everything off, had great credit scores, down payment, job history, had all of it, but just didn't have any real income the way that lenders wanted. So they fell into the subprime category. The reason it got kind of a bad name is it got started getting abused when everybody on Wall Street was just gobbling up mortgages because they were great investments. They were making all this money on the rates were higher on these subprime loans so they could make more money. They got looser and looser and looser with the guidelines. This is one of the big reasons we had the '08 crisis was how loose the guidelines got and how high loan to value and lower credit score and no income, no asset. The stated loans just went nuts. But I really feel they got thrown out with the bathwater. The baby got thrown out with the bathwater. That program still should be in the marketplace. There is still a need for people that have all the other boxes checked, have all the other criteria checked, loan to value, down payment, credit score, just have income verification issues. That loan should still exist, I think. It just got completely thrown out. So now what they're calling it, just like any good capitalistic market is going to find a way to repackage it and throw it back out there, is non-QM. So during the '08 crisis, there really wasn't a definition for certain things. So then they started defining, okay, what is a mortgage as far as regulation? What is a mortgage as far as the government's concerned, regulatory concern? What defines a mortgage? So they defined it. So anything that doesn't fall under that category is now what's called a non-qualified mortgage. So they call them qualified mortgages now. And so if you do those types of loans, you don't have any protections. So they're starting to come back. They're starting to get a little bit more aggressive. They're finding a need in the marketplace. They're doing make sense loans that are now being called non-QM. So subprime is kind of gone, revamped, rebranded. Now it's called non-QM. All right. How are we doing? Oh my goodness, 27 minutes. We've gone way over. So I apologize. This was a little longer than normal. I try to keep these a little bit shorter, but hope you enjoyed the videos. I have a lot of fun with this. I just get running away here with this stuff. But if you need a mortgage loan in Utah or Nevada, I'd love the chance to work with you. So you can check out my website, ryanbolton.com, just below here. You can check out my appointment calendar. So right at the top is my appointment calendar. You can download my mobile app. We can start there. There's no cost, no obligation, just reviewing your information. Even if you're not buying in those states and you just have a question for me, I'm here to do that for you. I've been doing loans since 1999 and just love answering questions and being helpful wherever I can. I feel if I give back, maybe that will reciprocate in the future, help me with generating loans. I like doing this, so I want to help people as much as I possibly can. So check out my website. Apply if you want online or submit a question, comment, click subscribe, all that YouTube stuff. But look forward to doing another video and see you next time. Thanks for watching.